Time is running out. Let me explain why. If you live in a UK, you have probably heard people talking about ISAs. But what exactly are they? And more importantly, why do they matter to you? By the end of this video, you will have clear answers to both questions and know exactly what steps to take to ensure you make most of your tax-free allowance. Because once it's gone, you can't get it back. Let's get into it. Imagine you have saved up some money and want it to grow. You could deposit it in a bank to earn interest or invest it in the stock market. However, normally any earning from your saving or investments are subject to tax. That's where an ISA comes in. ISA stands for Individual Savings Account, and it's essentially a way to save and invest tax-free. It's not an investment itself, but rather a protective wrapper or a special box where anything you put inside is shielded from tax. Whether it's interest from savings, profit from investments, or long-term compound growth, it's all yours to keep, untouched by the taxman. Each year, you're given an ISA allowance, which is the maximum amount you can contribute to this tax-free account. For the 2025-2026 tax year, this allowance is £20,000. Now, there are 5 main types of ISAs, each designed for a different purpose. First, you have a cash ISA. This works like a regular saving account, but all the interest you earn is completely tax-free. It's simple and low risk, making it ideal for those who want security over high returns. Then, Stocks and Shares ISA. This allows you to invest in the stock market, including shares, funds, and bonds, with all profit shielded from tax. It carries more risk but offers greater potential for long-term growth. Then you have Lifetime ISA. This special ISA comes with a 25% government bonus on your savings, but it's specifically designed for the first-time home buyers or retirement savings. However, there are strict withdrawal rules and penalties, which we will cover shortly. And then you have Junior ISA, a tax-free saving or investment account for children. It has a separate £9,000 annual allowance, which doesn't count towards your personal £20,000 ISA limit, making it a great way to save for a child's future. Then you have Innovative Finance ISA. This ISA is used for peer-to-peer lending, offering potentially high returns but with increased risk. However, we will focus more on the first 4 as they are the most relevant for most people. You can split your £20,000 ISA allowance across multiple types of ISAs like Cash ISA, Stocks and Shares ISA, Lifetime ISA, and Innovative Finance ISA. But the total contribution cannot exceed £20,000 in a tax year. The Junior ISA has its own separate £9,000 annual allowance per child, which does not count towards your personal limit. This means parents can maximize their own ISA contributions while also saving for their child's future. Now that we have covered the basics, let's break down each ISA type in detail to help you decide which one is best for you. Let's start with cash ISAs. If you save money in a regular bank account, you may have to pay tax on the interest you earn if it exceeds your personal savings allowance. Here's how that works. If you are basic rate taxpayer 20%, you can earn up to £1,000 in interest per year tax-free. And if you are higher rate taxpayer 40%, then you have a lower limit of £500 per year. And if you are additional rate taxpayer 45%, then you don't get any tax-free allowance. All your interest is taxable. If you are not using a cash ISA, you might be unnecessarily paying tax on your savings interest. It protects everything you deposit from tax, so you can keep 100% of your interest. For example, if you deposit £20,000 this year before April 5th and add another £20,000 next year from April 6th and then contribute £20,000 the year after, you could have £60,000 in a cash ISA, and all the interest you earn on that amount could remain completely tax-free. Just like the regular savings account, cash ISAs come in different types. Easy Access Cash ISA allow you to withdraw money anytime, offering flexibility but usually with a lower interest rate. Then, Fixed Rate Cash ISA requires you to lock in your money for a set period like 1 to 5 years in exchange for the higher interest rate. And then you have Notice Cash ISA, requires you to give advance notice, typically 30 to 90 days before making withdrawals. often offering better rates than easy access accounts. By choosing the right cash ISA, you can maximize your tax-free savings while balancing accessibility and returns. Now, what is a stocks and shares ISA? It allows you to grow your money over time by investing in assets like funds, bonds, and individual company shares. Unlike a regular investment account, all your gains within this ISA are completely tax-free, means you don't pay capital gains tax or dividend tax on your returns. However, inside an ISA, you would keep the full amount tax-free. While investing in the individual stocks can be a high risk, but a safer approach is to invest in the diversified assets such as the S&P 500, which tracks the 500 largest US companies, or a global market index fund, or exchange traded funds ETFs. Historically, these types of investment have returned around 7 to 8% per year, even after inflation. And with the stocks and share ISA, all your return remains tax-free. By taking advantage of a stocks and shares ISA, you can maximize your long-term investment returns while keeping every penny of your profits. Next up, we have a lifetime ISA. What is a lifetime ISA or LISA? This saving account is specifically designed to help you either buy your first home as long as the property costs £450,000 or less, or save for retirement. It works differently from other ISAs. You can contribute up to £4,000 per tax year, which counts towards your overall £20,000 ISA allowance. The government adds a 25% bonus on your savings, means if you deposit the full £4,000, you will receive an extra £1,000 in free money. There are two types. A cash LISA. It's ideal if you are planning to buy a home in the near future, or there's a stocks and shares LISA, which is better suited for long-term retirement savings as it allows your money to grow over time. While the government bonus is attractive, but the lifetime ISA comes with significant restrictions. You can only withdraw funds if you are buying your first home or once you turn 60. If you withdraw for any other reason, you face a 25% penalty, which results in an overall loss of more than 6% of your original savings. The £450,000 property cap has an increase in years, making it difficult for the first-time buyers in areas like London and the Southeast to find eligible homes. Right now, the withdrawal penalty and outdated property cap make the LISA restrictive, especially if you are planning to buy a home that exceeds the limit. If the penalty were removed, it could become a more attractive option for our first-time buyers. And then finally, what is a junior ISA? It's a tax-free savings or investment account designed for children. It allows parents to save or invest on behalf of their child, ensuring their money grows without being taxed. You can save in cash, invest in stocks and shares, and do a mix of both. The annual allowance for a junior ISA is £9,000, separate from your personal £20,000 ISA limit. This means you can max out both your ISA and your child junior ISA in the same tax year. And how a junior ISA works. Firstly, parents open and manage the account. The child gains control at the age 16 but can't withdraw the money until they turn 18. Once the child turns 18, their junior ISA automatically converts into an adult ISA. It helps to build a financial safety net for your child's future, whether for university, a house deposit, or their first investments. Since it's tax-free, every penny earned stays in the account. That's everything you need to know about ISAs. While they may seem complex at first, but they're straightforward once you understand the basics. And if you enjoyed this video, you will also enjoy this one right here on 12 Tiny Habits That Will Make You Rich.